Are you looking for the next big investment opportunity in the stock market? Whether it's cutting edge technology, hidden gems, or stocks the market has overlooked, today's video has got you covered. We'll explore standout companies poised for growth, including an innovative robotics leader, a legendary sportswear brand, and more. Hey, my name is Steve, and on this channel, we analyze undervalued or out of favor stocks that have the potential to deliver long-term returns. My goal is to bring you clear, in-depth analysis of market opportunities to help you make smarter investment decisions. Today, our first stock is a company that's transforming its industry with game-changing innovation. And that company is Symbotic, ticker symbol SYM, which is a leader in robotics and AI-driven warehouse automation. It is a company with immense potential, but when currently navigating turbulent waters, the stock is trading at $31.38, down over 30% from a year ago, largely due to financial reporting issues. Let's dive deeper into what's happening with Symbotic and whether its current challenges present an opportunity for long-term investors. Symbotic late last year announced material weakness in its financial reporting, including errors in revenue recognition and expense accounting. These issues forced the company to delay the annual 10K report and restate earnings, which is expected to reduce full-year adjusted EBITDA by 30 to 40 million. The market reaction to this was swift, with Symbotic stock plummeting nearly 40% in a single day, erasing billions in market value. Analysts downgraded the stock, emphasizing concerns about governance and financial controls. The sell-off underscores the sensitivity of the market to perceived weaknesses, especially in a high-growth, high-valuation company like Symbotic. What does this company do? Well, Symbotic specializes in AI-powered robotic systems that revolutionize warehouse automation. These systems streamline operations for major retailers, automating tasks like pallet movement and order fulfillment. Symbotic generates revenue through system sales, ongoing maintenance, and software licensing, creating a mix of upfront and recurring income. The company boasts an impressive client roster, including Walmart, which is its largest partner, and is deploying Symbotic systems across all 42 regional distribution centers. Additional partnerships with Target and Albertsons strengthen its market leadership in retail automation. These relationships showcase Symbotic's strategic importance to some of the largest players in the retail industry. Symbotic's revenue growth has been remarkable. For third fiscal quarter 2024, the company reported $492 million in revenue, representing significant year-over-year growth. However, the restatement of earnings cast doubt on the accuracy of past financials. We'll have to wait and see how accurate this reporting was in upcoming earnings releases. But despite these issues, Symbotic's technology addresses a rapidly growing market. The warehouse automation market is projected to grow at a compounded annual growth rate of 13.6%, reaching an estimated $51 billion by 2030. Symbotic's innovative solutions position it to capture a significant share of this market, provided it can resolve its internal challenges. So should you consider investing in Symbotic? Well, it's a speculative investment opportunity in a transformative industry. Its cutting-edge technology and partnerships with major retailers suggest substantial growth potential. The stock's steep decline may present a buying opportunity if financial issues are resolved. That said, financial uncertainty poses significant risks and volatility is expected. Dollar cost averaging or waiting for further clarity are prudent strategies. For investors, Symbotic represents a high-risk, high-reward opportunity. Stock number 2 is Nike, one of the most recognized brands worldwide and has long been a staple in the athletic footwear and apparel industry. However, its stock has faced significant headwinds in recent years, currently trading at $73.57, a far cry from its peak of over $170 in 2021. Let's explore why Nike is out of favor with the market and why it could still be a compelling investment opportunity. Over the past 5 years, Nike's financial performance has shown both resilience and challenges. From 2019 to 2024, the company achieved an average annual earnings per share, or EPS, growth rate of approximately 8.8%. However, recent fluctuations tell a more nuanced story. In fiscal year 2023, Nike's EPS declined by 13.87%, falling to $3.23 from $3.75 in 2022. This was primarily driven by inflationary pressures, supply chain disruptions, and declining gross margins. While revenue has grown over the long term, challenges in certain regions, particularly in China, have impacted overall sales momentum. There also are macroeconomic headwinds. Global inflation, shifting consumer spending habits, and rising costs have weighed on Nike's profitability, leading to a more cautious outlook from investors. Competition. Emerging players like Hoka and On Running have gained market share, intensifying competition in the athletic footwear segment. Nike as a company is going through a strategic shift. Its push towards a direct-to-consumer model, while strategically sound for the long term, has strained relationships with wholesale partners, creating short-term sales pressures. But here's why I think Nike could still be a strong buy. The Despite recent setbacks, Nike remains a fundamentally strong company with significant growth potential. It has unmatched brand power. Nike continues to dominate the global market with a presence in over 170 countries and reputation for innovation in athletic performance and lifestyle apparel. It's undergoing a turnaround strategy. Newly appointed CEO Elliott Hill has launched initiatives to revitalize Nike's retail partnerships, refocus on core sports categories, and reduce reliance on discounting. These steps aim to restore growth and profitability while strengthening the company's competitive positioning. Nike is currently in a transition phase, facing near-term challenges but implementing strategies to reignite growth. For long-term investors, this represents an opportunity to invest in a world-class brand at a time when the market is undervaluing its potential. While the journey may require patience, Nike's strong fundamentals, strategic initiatives, and enduring global appeal make it a stock worth considering. Before we move on, I want to quickly mention that the stocks I covered in my January 2025 video, SMCI, HIMS, Celsius, and Micron, are still strong buys for me. I'm continuing to invest in those alongside the stocks in this video. If you missed that breakdown, I'll link to it at the end so you can check it out. Now let's shift gears to quantum computing stocks, one of the most exciting and volatile areas in the market. Quantum computing is still in its early stages. That means investing here is speculative, but for those willing to take the risk, it could be a game changer. What is quantum computing? Well, this is an entirely new way of processing information. Unlike classical computers that use bits, which are either 0 or 1, quantum computers use qubits, which can be 0 and 1 at the same time. This allows quantum computers to solve problems exponentially faster than traditional machines. However, while the potential is enormous, the technology is not commercially viable yet. There are significant engineering and scaling challenges that still need to be solved before quantum computing becomes mainstream. Why did quantum computing stocks boom and then crash? In 2024, quantum computing stocks soared as excitement around AI and advanced computing spilled over into this sector. Companies like IonQ and Rigetti Computing saw their stock prices skyrocket. But then NVIDIA CEO Jensen Huang made a statement that shook the market. He suggested that useful quantum computers might still be 15 to 30 years away. This comment reset expectations, and quantum stocks plummeted as investors realized the commercial viability of this technology might take much longer than we initially thought. This is a key lesson in speculative investing. Hype can drive stocks up, but real progress and revenue generation determine their long-term success. Here are the top quantum computing stocks to watch. Number 1 is IBM, one of the pioneers in quantum computing. IBM is working to offer cloud-based quantum computing services and continues to push advancements in quantum hardware and software. Number 2 is Alphabet. Google's quantum AI lab has made major strides, including achieving quantum supremacy in certain calculations. Next, we have Microsoft's Azure Quantum, which is integrating quantum computing into its cloud ecosystem, making it accessible to businesses and developers. IonQ is a pure-play quantum computing stock focused on trapped ion technology. IonQ is seen as one of the most promising standalone quantum companies. Rigetti Computing, another dedicated quantum computing firm, Rigetti is working on building scalable quantum processors to compete in the commercial space. Then we have D-Wave. Unlike most competitors, D-Wave is focused on quantum annealing, a different approach to quantum computing that is already being tested for practical applications today. So should you invest in quantum computing stocks? Well, let's be clear here. Investing in quantum computing is not for the faint of heart. There is some potential upside. If quantum computing becomes commercially viable, early investors could see massive returns. This technology could revolutionize industries from pharmaceuticals to finance. But there are major risks. These companies are burning cash without generating significant revenue yet. And there's also no guarantee that their technology will work at scale in the next decade. For me, I've started a small position in a couple of these quantum computing stocks, and my plan is to continue dollar cost averaging over time. But I'm going in with the mindset that this could either be an incredible long-term opportunity or it could go to zero. This is a high-risk, high-reward play, so I'm only investing with what I'm comfortable of potentially losing. The final stock on this list is Sofi Technologies. In today's rapidly evolving financial landscape, Sofi Technologies stands out as an innovative company poised to redefine the future of banking. As of February 1st, 2025, Sofi is trading at $15.78 per share, reflecting a slight decrease of 4% from the previous close. Sofi's recent financial performance underscores its robust growth trajectory. In the fourth quarter of 2024, the company reported a net revenue of $734 million and net income of $332.5 million, translating to diluted earnings per share of 29 cents. While these figures surpassed market expectations, the stock experienced a temporary decline due to the conservative future earnings guidance. In 2024, Sofi achieved several milestones. Number 1, profitability. The company reported profitability in all 4 quarters under generally accepted accounting principles, with earnings consistently surpassing expectations. Strategic partnership. SoFi secured a $2 billion personal loan agreement, enhancing its lending capabilities and market reach. Market recognition. The re-election of Donald Trump in November positively impacted the stock, promising a less restrictive regulatory environment. The traditional banking model is shifting towards digital platforms. Younger generations, in particular, demand seamless online financial services that offer convenience, transparency, and efficiency. SoFi is at the forefront of this transformation, providing a comprehensive suite of online financial solutions tailored to modern consumers. Analysts project that SoFi could emerge as a top 10 financial institution by deposits in the near future. As the financial industry continues its digital evolution, SoFi is uniquely positioned to lead this transformation. For me, I am buying this dip on SoFi and plan to hold the shares for the long term. I'm not a financial advisor, and this video is for informational purposes only. It should not be considered financial advice. Always do your own research and consult with a financial advisor before making any investment decisions. And here's that link right here to my January stocks to buy video if you want to check that out. Thanks for all of your support, and I'll see you next time.